Welcome to this special update by Mint.com. My name is Brad Matheny. We're going to start by taking a look at the U.S. real estate conditions, which have changed dramatically over the last 5 to 6 weeks. What's important to understand right now is that we are seeing the Fed raise interest rates, and in doing so, trying to tamp down inflationary concerns, which are the highest we've seen since 1982 or 83. We've left normal activity. So this is normal activity in the housing market. This goes back to July 2017. You can see we've gone through a number of periods here. We have median price, listing price value year over year in blue. We have active listing count in kind of a dark orange. We have median days on market in gray. We have price reduction count in this yellow area. And we have price reduced share year over year in this light blue. What's happening right now, ladies and gentlemen, is we had a fairly stable market where reductions were minimal. Active listing counts were fairly solid and growing through this period. Growth in the market was holding substantial, up in the 5, 6, 7%. And then we move into 2019, and you can see we start to see a decline in active listing counts. We see a decline in reduction counts. The market is starting to get super heated. This was when the Fed raised interest rates here to 2.5%. This is when the Fed lowered them to 1%. And then we move into COVID right in this area. And this is when the Fed lowered interest rates to near zero, superheating the market. You can see that we had a median days on market shot up initially with COVID, and then just turned right back around and went uber negative. This means that it's superheated. Everybody was trying to buy at low rates. Prices started to skyrocket. This created a superheated real estate market. And now the Fed, again, behind the curve, trying to stop inflation, is likely to try to raise rates to about 1.25%, maybe 1.5% on a Fed funds rate, which will push interest rates up into the 6.5%, maybe a little bit higher for mortgages. You can see what the current interest rate increases have done. Prices are still elevated. Sellers are still trying to dump at the highest prices they can. Price reductions, though, have shot through the roof. They're now up close to 60% of all homes on the market are being reduced in price, trying to attract buyers. You can see here active listing counts have started to shoot up. This means that more and more houses are coming on the market. People are trying to dump at these prices, knowing that the Fed is going to topple the market fairly soon. And you can see days on market has gone from an extreme low of about minus 30%. We're back down to minus 18%. This will push higher as buyers disappear. So you can see here, now we have also here, the price reduction share of market is starting to creep back into positive territory. So what's going to happen, ladies and gentlemen, is we're going to have a very interesting shift, possibly another housing market crisis. It's, in my opinion, 2 to 4 months away. I predicted with a friend of mine back in December, January, that within about 6 months, you could see a 25% decrease in prices. You've already witnessed about a 10% decrease in prices already. A lot of major homes are already dropping by 10% or a little more, trying to attract buyers. But buyers are very savvy, and they work like a flock of sheep or a flock of birds. Once buyers start to see the markets change, they start to wait. They pull away. They know that they can't chase these high prices unless they're fully qualified to get in, and it's not going to hurt them no matter what. They wait. Just like in 2008, 9, 10. They wait until the deal is right, and they try to buy at the lowest price possible. Why chase out it when the market is already starting to tank? It hasn't shown here yet, but it will. Now, well, let's take a look at consumer index here. Consumers have pulled away at the fastest rate in the last couple of weeks that we've seen pretty much since 2009. This was the 2008-9 collapse. And you can see that it was short-lived. It didn't present too much of a crisis event. We had the rollover here in 2014 which was Fed-based. We had the rollover here 2017 prior to the elections. And then we saw it after the election, 2017, a little bit of a change. Stock market took off. Consumers were rather shy at first, then started taking off. This was COVID. Now we see this rally back out of COVID, and you can see consumers have been pulling away at this top. They're very well aware that the market is toppy and that the Fed is way behind the curve, and they're starting to pull away from the market, pulling assets away from the market, preparing for what may come with this high bout of inflation. This is the most selling we've seen in over 11 years. I mean, it's ungodly what we're seeing with regards to consumers pulling away and anticipating what could be a very deep decline for asset prices with related regards to inflation. And this basically all comes down to what the Fed has to do to stop inflation. They have to break cycles. This cycle took place really from 2015 onward. You can see we've gotten very high here. The Fed kept pushing money into the market, trying to stabilize growth. Growth was already there. We were already at near market highs in 2013 and 14, but they pushed it even further and elevated it even further. The idea of free, easy money seemed endless, and that pushed price levels much, much higher. Consumers right now make up almost 3/4 of GDP production, and I think consumers pulling away from the economy in the U.S. and abroad is going to be a very telltale sign that we are now entering severe risk. Next, let's take a look at the gold cycles. Gold cycles have been explosive during periods of economic and monetary expansion. So you can see here, this was the late 70s. After we ended the gold standard and entered a period of credit expansion, you can see gold rallied excessively from basically $70 an ounce up to $840 roughly. Huge 1,000% increase during a credit expansion period where the Fed was printing money and a new form of credit was created by eliminating the gold standard. In this period, which was a depreciationary cycle phase, we didn't have a massive amount of spending, and it didn't relate to any fear event. That's why gold stayed rather flat. Here in 2000, we had, of course, the dot-com bubble burst, which was an excess phase bursting. Then we had the 9/11 attacks, and gold started this massive run from about $240 up to almost $2,000. This was a big expansionary phase where pretty much an excess phase, a speculative bubble, and this included housing. This included a ramp-up period. You can see here 2008, 2009, the housing market collapses. Gold continued to run for another 3.5 or 4 years before it peaked out. Okay, there's 2008 to 2012. Now, this cycle, we have even more debt increase with regard to the Fed, more money printing. It has gone up by almost $4 trillion from this cycle. From this cycle until here, we've basically gone up over $4 trillion from this 2008 level to this level, and I believe this move in gold could be excessive. I mean, I don't think anybody has any real clue what the market is capable of doing here, what gold is capable of doing here, but I believe the fear, as this fear sets in, money is going to move into key assets for hedging and protection. And that's the point of this update, is to show you that we're setting up for a potential bubble burst, a potential deeper asset unwinding, meaning we could see asset prices fall for another at least 12 to 24 months, possibly longer, dollar included. And that could push gold, excuse me, much, much higher. I'm talking above $3,600 an ounce, which would be basically a 400% increase from these levels. Could potentially even go above $5,500 an ounce. Now, next update is the gold cycle chart. This is a custom gold cycle chart showing you how we've reached a base and we've started to bottom back here. And in theory, what this is showing you is that gold has rebounded down into levels that we have not seen here since 2018 or 2014-15, and really it's bottoming out back over here in levels where we saw in 2009. Now remember, 2009 was back here. 2009 was back in this area. So in relative price terms, gold right now is bottoming at a relative price term which would equal to this low down here in 2009. And that, of course, equals the high back over here. So understand that the real price function here of gold is that gold is extremely undervalued. It's bottoming. It's bottoming down here in this support level, down in this, let's call it 25-30 range. And the explosive side here is that gold could run from this area possibly 300% from 30, possibly up to 90, 100, 120. That's a 300 to 400% rally mode here. And if we take a look again at gold, right here, gold is trading at roughly 1842. So you figure out what 300% of 1842 is. That's going to put us at about $5,500, $5,700 gold. 400% would put us at around $6,500 gold. It's very, very explosive. Now, what else could money start chasing? Money could start falling back into emerging market cycles. This is an emerging market ETF, the EEM, and what you're seeing here is we're having a sell-off recently. It's selling off from the mid or early 2021 highs all the way down here near these lows. I want you to understand here that we could still have a deeper sell-off in emerging markets, another maybe 6, 8, 12 weeks down into these 36, 32 level, down here near these lows or these lows. Ultimately, this is what happened in 2008, 2009. Emerging markets collapsed. And then we saw a big rally, 100% rally in emerging markets because traders perceived emerging markets with the support of the Fed and China still having solid growth, saw emerging markets really begin to rally. What I'm telling you is that I believe this could turn into another rally of 60, 70%, but we need to wait for this to find a bottom. We need to watch this actually move lower and try to find a bottom. Now, what I'm going to show you here again is this, the yin, Y-I-N-N. It's a 3x bullish China ETF. You see this area here of support in the blue box area? Historically, this has been very low support. So this is price support down here near the 1250 area, and we're all the way down here to 3.79. I believe this is already wound out. It could go a little bit lower here, but I believe this is a very good opportunity for approximately a 300 to 500% rally over the next 24 months. That would put us right there. So back up to 10, 11, 12, maybe up into the $20 area here, which means that we would potentially be looking at a 437% increase. But again, timing this is going to be critical. I believe we're looking at a very solid low. And if I go to a daily chart here, you'll see the lows that set up back over here on the deep selling, $2.86 roughly. So hypothetically, below $3 is going to be a very good entry point here for yin. And remember, it's going to want to form a bottom. It could still be 12 to 24 months out before we see anything move up here in this $10 range. But I believe capital will shift away from U.S. markets into gold, into silver, and into some emerging market trends, trying to find safety and security with the chance for some profits. So understand that we're getting into that mode in the U.S. markets where as capital starts to flee the risk of the Fed and falling asset prices, it's going to be very interesting to see how capital moves into these extreme undervalued charts. And like I said, in this area, really you have an opportunity down here in the let's call it 320, 340 or lower, really, to try to buy and wait this out. As a matter of fact, if you were to have money in your 401k, or if you were to have some money stashed aside, you wanted to play a little bit with this potential setup, there's a fairly good chance that when all the dust settles, emerging markets and China could recover before the U.S. markets actually begin to recover. This could move 20, 30, 40% higher, where the U.S. markets may attempt to move 10, 11, 12% higher before forming a base. It happened back here in 2008, 2009. The U.S. markets were still basing in 10, 11, 12, looking for growth, whereas emerging markets rallied from 20 up to almost 55, 52. That's a 130, 140% move. If we see the same thing kind of take place here after this deeper sell-off, understand that the buy mode coming higher is going to be quite solid, in my opinion. So be prepared for the capital shift. Be prepared for what's going to happen when capital starts to seek out opportunities, and be aware of where these opportunities are. Foreign markets may be great opportunities for small amounts of money, maybe 10, 15, 20% of your portfolio, where you can still leave the rest in U.S.-based assets and try to take advantage of opportunity that occurs when the bottom sets up. All right, that's it for now. We'll keep you updated.